We haven't seen true panic yet for the SP 500 and Bitcoin, but don't let that fool you thinking that the bears are in control. Today's video, let's look at some of the data that is showing that we may not get to that extreme panic zone this time round, as we may have already seen the extreme panic in 2022. What you may have seen though is the like button getting smashed up down below. All right, terrible segue. Subscribe, bell notification icon. And a quick shout out to our trading community. If you guys want to get involved and get those sweet, juicy profits, long and short in cryptocurrency, link is in the top of the video description here. Get trading now with our free trading strategies. Go on the waitlist. That is now closed, but we do have another trading workshop coming up. So get your name in nice and early so you can get on board for the next trading workshop for those free trading strategies and learn how to make profits like some of our members are already doing. Of course, the talk of the town this week is the FOMC meeting coming up, and if the Fed will raise interest rates, federal funds rates, people are expecting 0.25% rate rise, going from 4.75 up to 5%. And of course, this continues to lead the bearishness and the fear in the market to say that we are expecting a recession. This talk of expecting a recession started early in 2022. If you haven't been around in the markets for over 12 months, this has been going on for a very long time. Eventually, these fears fade, and that is what we are looking at in terms of the market sentiment and the data. So we're getting more information, more posting headlines from the US. The US explores measures to guarantee all bank deposits if crisis grows. Now, I'm not saying that there will never be a recession. I think a recession will definitely come. It's guaranteed. We'll always have one. That's a boom and bust cycle. However, the thing that is not lining up with what the data is saying and what the media is saying, and then of course the biggest talking heads out there, is the timing of when this recession will occur. Now, even if the recession does occur this year or next year, the point that we need to focus on is it going to be a land-led recession? A land-led recession is something that stems from the underlying greatest, biggest assets in the world, and that is the land value. Are we going to see a collapse in land values? If we get a collapse elsewhere in the system, it's not as severe unless it's from the land, if the land drops first. And we're not expecting that in terms of the 18-year cycle until 2026 or beyond, probably beyond, which is why I have here 2027 or later. And that's why I put this post out on YouTube, just to get an understanding of what you're seeing out there or what your views are in terms of the recession. So a land-led recession is what will collapse the system, and that's not due for another few years. So it's really important to note that at this point in time, especially as we start to see some of the data swing in the way of the bulls. So we're seeing the market sentiment change here with people looking at the government coming in to step in and help the situation out, which of course we couldn't predict that they would do it. Most people thought it would happen if there were problems. But now we're starting to see that bearish narrative change, going from very heavily bearish that the system must collapse to now the beginnings of the narrative shifting to the bullish side, saying, well, if things do go down, the banks or the Fed's going to step in and help these banks out, which of course is working its way into the stock market, and what we're about to have a look at in just a second, with those prices increasing, with lows coming up. So this particular chart here is showing that the credit spreads are not showing true panic. We saw true panic at each of these key bottoms in the market, in the cycle. You got some key bottoms here in 2002, 2003. There is some extreme panic, more extreme panic circled right here. Again in 2016, again at the pandemic low, but right now we are well and truly down here. This is essentially the triple B rated corporate bonds minus the triple A rated corporate bonds for the spread in that yield. And it is not showing true panic. So we're not seeing true panic in these markets, but we may not have to see this true panic. As long as these spreads remain muted in their response, it makes sense to stay calm. That's what has happened over the course of the history of this data right here. You can see, even though we had some heightened fears, the market moving up here, the spread increasing, there's still no need to fear what the headlines are telling us in comparison to what the data is showing. This is a chart of the small trader put and call premium. Now, if I move myself out of the way so we can see the chart here, the peaks come at the bottoms or around the bottoms of the market. As you can see right now, we are getting lower highs forming in the market, which essentially means that the puts are coming off and the market is basically returning back to a more neutral place and potentially going into a bit more of a rising market. This will take time, but at least we're starting to move away from these bottom areas, basically the puts being too far above the call ratio. And that is basically a signal that the bottom is in. Throughout history, we can see that this has occurred. You can see back here in 2002, 2003, around the lows, the same sort of thing here where the put call premium spiked, and then we had the lower highs form. We had it spike again, 2008, 2009, and the lower highs formed again. We can go throughout each of these little spikes here and look at those peaks that we had around 2015, 2016, also bottoms in the market on the way up. We had the 2019 spike right here, and then again the spike on the traders put and call premium. Here is the COVID bottom, another spike. Yet again it happened, and throughout 2022 there was a lot of traders trying to get in short in the market when the market was bottoming. That was the period through June was the first one, then October, and then we saw December, and currently we're in March. So each of these occasions, we're starting to see a drop on the premium. When the small trader put and call premium is above 90%, so basically where we currently find ourselves, what they've found, going back through the data, just the facts here, the S&P 500's future annualized return was over 48%. So essentially, these small traders are getting it wrong again. And the annualized return for the S&P is 48% over the next 12 months. I'm not saying this has to happen. This is just looking at the data from what has happened in the past. And if we look at the annualized return, exactly here, 48%. Now, when they spent 30% or less on puts, the return plummeted to negative 10%. So basically, it's got to be well down below here at these bottom levels. But you can see here, we're at the top levels. Typically, it's a 48% return. I don't want to bet against that sort of data. Now, I might be a contrarian in the market right now, but I'm not going to be a contrarian against this sort of data. A nearly 50% return on the S&P when this signal comes in. Now, my favorite type of data is, of course, the charts themselves. I love to follow what the volume is doing because that essentially is the amount of trading activity that is going on in the market and getting a reading on how high that volume is. How many traders and investors are really interested in getting into the market right now, or at least playing in the market right now. And the more we see higher bottoms form, in particular higher than the cycle low, which so far is the October low here, with volume, that starts to really take a toll on the bears in the market. Now, if we take a look at the volume here for the S&P 500, of course, before we get to Bitcoin, this has been one of the highest volume weeks on record. Last week, we saw a volume here for the S&P at 14.234. The previous time we had something that high was the September to October low. So we had a bottom here in September. The market went slightly lower and then we springboarded away from that point here. So that volume came in at 14.48. So something that could happen, which could send the bears into a flurry, is that we move up for a little bit and test those lows again, maybe just take out some of the stops of December of last week, and that would get the bears really going hard, and then we start to move away again. That's what happened in September, like you can see back here from this particular bar. We had a low, the market went slightly lower during that week of October, and then we sprung right out of that point there. You can see it also happened in June, which is why we were talking about June being a potential low. There was a lot of hallmarks of June being a low. We sprung away quite quickly. We had high volume here, and the market basically turned very, very quickly. And in terms of what came next, we got a slightly lower low here in October, but again, the market bounced away from that point. Do we see that again on a shorter term time frame? That's anyone's guess at this point. But even if that happened, I'd still be in the bullish camp because of the signals that we see here in terms of how the market is finding support and bouncing away, and of course the volume. Now this goes on throughout history, and I've gone through it in many other videos just to give you a couple of recent examples here. Obviously the COVID bounce out of that low, extreme volume, and then back in 2018 as well, we had another extreme volume here. The market bounced away, and because I can't help myself, another one in 2018, extreme volume, and the market bouncing away again. As for the VIX, price continues to come down on the VIX here. We had a 5% down day yesterday, so a 5% drop on the VIX, meaning the volatility is decreasing, which typically means the market is preparing to move up again. So you can see here all the higher lows coming in, and we have some lower lows coming in on the chart here. Ideally, we want to see the VIX get back under 17 to get back into that bull market territory. The US dollar, or as some like to call it, the Dixie, as the symbol is DXY, also had a down day yesterday, just about 0.5%. We're sitting on 50% now of the move up from the low. And like we've talked about many times before, this could be a 9 to 14 week range where the market is just trying to figure out whether it's ready to go up a little bit higher and test some higher prices. But overall, in the macro structure for the USD, this looks like it is a bear market rally. Can't see the US dollar going back on some big strength run here, taking out 10.15, which is the current top. It looks like we have another leg down to put in based on what we've seen in history, something that we've covered many times before on the channel, looking at how this pattern continues to play out time and time again. Big moves to the downside, a pause, a time to regather, and then another move to the downside. If you've been here through that journey, hit that like button, subscribe to the channel. Let me know in the comments down below if you think the US dollar is going to continue falling or if we're going to go on a charge. The camp is still split down the middle here, whether people think the US dollar is going to fall back below the support levels of around 100, 102, or if we're going to go on another charge and take out 115. As for Bitcoin, we're starting to get less split on what's happening here. The bears are starting to get a little bit more quiet. The bulls are obviously coming back out in force recently, with the crazy news of $1 million Bitcoin in the next 90 days by Balaji. Essentially, this is the time where heroes come out of the woodworks and start to really spread their wings and show off their feathers to say that Bitcoin is the next big thing, to spread warning signs to other people. This is just part and parcel of the narrative and the game of investing. Let's not get swept up in this whole $1 million calls. We know it's absolute bullshit. They do too. It's a marketing ploy. Good on them for that. I should probably do the same thing at some point. Nonetheless, what's happening with Bitcoin right now is it's just hanging out just below $28,000, which is also another resistance level. If we take a look back at where the market was before the collapse of Celsius, Voyager, BlockFi in June, the market was hanging out here at around $28,500. So it's some key resistance at the moment. The good news is we've bounced pretty solidly away from the log downtrend. Bitcoin cycle bottom back here at 15.5, nearly at 100% jump from that 15.5K low. 15.5K times 2 for a 100% move is 31,000, and there's every chance that Bitcoin could reach up to these previous levels here at those low $30,000 levels. Not to spread too much hopium to the downside, just to keep us prepared. The further up we go, the better it is for any sort of correction, because that gives us more room to move to the downside. Now, of course, we're going to continue watching these levels at 25K, so just listen to the bears get really, really crazy should the market start to fall. But anything above 24, 25 is still going to be pretty safe keeping for the bulls. There is a ton of noise in the financial media right now as both the stock markets and Bitcoin seem to be going through a transitional period from the bears to the bulls. It's not going to be easy. I'm not saying we're going straight up to new all-time highs, and we will get some fearful corrections where the bears believe they're back in control. And hey, what do I know? I don't have a crystal ball, but what I do have is a fantastic segue to joining our free crypto and economic report. Link is in the top of the video description. while I'm here, shout out for our free trading strategies. Get on board that new sign up list here, as the previous workshop is now full, but we will be holding another one soon. So make sure you do get onto that nice and early to get on board for that next one. And in the meantime, Bybit and BitGet are doing an exclusive cash giveaway along with their massive sign up bonuses as they have going on, up to $300 just for depositing $1,000 on each of those platforms. This is an exclusive for these links in our description for the next 10 days until the end of March. So get on board with that if you haven't already. I'll see you guys at the next video after you like and subscribe. Until then, take care and peace out.